Hello, everyone. My name is Geraldo Olivo. I'm a financial advisor at Bogart Wealth. Thank you so much for joining us today. I'm just going to give about a minute or so as we have folks join in to the meeting. So just briefly, I am a certified financial planner, financial advisor, part of the team here at Bogart Wealth. And what I'm going to go ahead and do now as we have folks joining the meeting, let me go ahead and share my screen and we'll go ahead and get started. Okay. All right, I'll get that set up. All right, so what you're looking at is today's presentation. What we're going to go over in depth is how current interest rates impact your retirement savings. We're also going to go over a few other topics, covered calls as well, and then a few updates for the One Big Beautiful Bill Act and how that can affect your financial planning for this coming year as well. So a lot of good stuff to go over. Excited that you guys are here. So let's go ahead and get started. All right. So also just a quick housekeeping note, we will be able to have a Q&A chat, so that will be open. So I'm going to go ahead and have that set up for you guys. So during the session, if you have a question, just please feel free to put it into the Q&A chat. And then at the end of our presentation, we'll go through the Q&A on depending on time allowed. Okay, perfect. Let me go ahead and we'll get started. All right. So today, first off, welcome to Bogart Wealth. What you're looking at is a QR code. If you'd like to get in touch with anyone from Bogart Wealth, again, we have a great team of financial advisors. Part of what we do with folks from ExxonMobil and other companies, you can scan that QR code and it'll take you to our website where you can enter in your contact information. We do a free consultation. Basically, we'll sit down with you and gather your data. If you're open to that, do a free financial plan, getting to know you. That's how we build relationships. And it's a great way to see where you're at. There's absolutely no obligation, but it's a great way to take this big picture data of what we're going to look at today and how it applies specifically to your situation and goals. So feel free to reach out anytime. So today's agenda, we're going to be going over interest rates. So basically discount rates and how that affects your lump sum amount. We're going to be looking at specifically the intricacies of how are lump sums calculated. We're also going to go over covered calls, and then we'll have a time for a Q&A as well. So a bit about Bogart Wealth. Some of you may be familiar with Bogart Wealth, maybe you've attended some webinars. Awesome. Please keep joining us. We do have these webinars and podcasts on a regular basis on various helpful topics. But brief overview, we were founded in 2016 by James Bogart. Right now we have offices in 3 locations. We're in McLean, Virginia, the Woodlands, Texas, where I'm coming from you today, and also Houston. We work with about 1,400 clients. Primarily, most of those folks are from Fortune 500 companies. So again, Fortune 500 company executives and professionals. Right now, we manage about $3.1 billion of assets under management. And then we have just over 50 employees. So, all right, now to get to some of the meat of the presentation. So how do discount rates affect your lump sum? So when we're speaking about interest rates today, I just want to make a quick note that this is geared, our webinar today, towards the ExxonMobil pension program specifically. This could relate to someone who does not work at ExxonMobil, but that would depend on what their pension options are and how their company manages their pension. Today's webinar is going to give us an idea of what interest rates are doing across the board and how they impact various parts of the ExxonMobil pension program specifically. And also, too, just a quick note, when we're talking about the pension program today, we're going to be focusing specifically on the qualified pension at ExxonMobil. So for some of you on the call today, you may have some of the non-qualified pieces, such as the supplemental pension plan, the SPP, or the other program, APP. This call is still relevant, but will mainly be focused on the qualified pension portion. But one thing to keep in mind, all of the interest rates, of course, affect both parts of the pension. So which discount rate applies to me? This is the question that comes up a lot. And so how does it actually affect my situation? So for almost everybody here, all you need to remember is the general rule. The rate that is in effect on your benefit commencement date, or your, and it's referred to as your BCD, will be the one that applies to you. So benefit commencement date, and this is a great thing to keep in mind for your notes. Benefit commencement date is always the first day of the month. So it doesn't matter if the first day of the month is a holiday. So for example, to get to the second quarter discount rate, the absolute latest that your benefit commencement date can be is that June 1st, because in July 1st, you would already be in the third quarter. So just as a brief example. Now, there is an exception to that, and I don't know if there are any grandfathered folks today joining us or not. And we'll get back to the definition of grandfathered in just a minute in terms of the pension. But we're really focusing on is the Pension Protection Act of 2006 and grandfathered in terms of that specific act. So for those grandfathered individuals, they have the option that if they choose the first available benefit commencement date, then they can choose the interest rate on their first day of retirement or the interest rate on their BCD or benefit commencement date. So in a nutshell, what this means is that an individual would have to make their last day of employment on June 29th, for example, and this would result in their first day of retirement on June 30th. They would be able to choose either the second or third quarter interest rates. This applies to very few people. We do believe it's important, just in case we do have folks on the call that what this applies to. But again, what that specific grandfather part applies to very few folks, but there is still a lot of confusion around this. So we just want to make sure that we're thorough and go through that with you today. So speaking of Pension Protection Act, that's a tongue twister, but Pension Protection Act of 2006. So this went into effect in 2007. The most important part of this is that it places limits on companies who provide lump sums. So it's really setting some parameters in terms of how companies offer pensions, how they calculate them, financial stability, et cetera. So for example, a pension must now have 80%, basically must be 80% funded in order to offer 100% lump sum option. So if their funding levels drop, then their lump sum options can change. This has never happened to ExxonMobil, so we don't focus on it as much. The Pension Protection Act defines what the discount rates are that can be used. The main thing to keep in mind, or a takeaway, is pre-Pension Protection Act of 2006, what was utilized was Treasury rates. Now, the Pension Protection Act has defined those as corporate rates must be utilized. Additionally, and I'll get into more on that in terms of how that affects your overall calculations and just a bit later in the presentation. So additionally, it requires that companies for the Act, they need to update their actuarial tables every 10 years. So the last update was done in 2018, so they must make an update by 2028. But if they wanted to, they could adjust sooner if they wish. So there are some other items that were changed, but some of them don't affect the lump sum pension option. I wanted to make sure that we touch base on the highlights, that some really key takeaways from this act that would affect you in your current planning. So going back to in terms of post Pension Protection Act. So those who are under 50 or under 10 years of service from December 31st, 2007, the new pension plan rules apply. So part of those pension plan rules are those corporate rates that are now utilized to determine the discount rate. The Pension Protection Act states that you have to use 3 segmented rates based on high quality corporate bond yields. Those are actually published on the IRS website. So one thing to keep in mind, and this makes a big difference, corporate bonds usually have higher yields than government bonds. Again, key takeaway from we'll go through a lot of data today. Just remember that higher yields are bad. And this is a rule of thumb. I'll bring it up now, and I'll also bring it up later when we go through the calculations. One big takeaway is this. Corporate bonds are utilized now versus Treasury yields prior to the Pension Protection Act. Corporate bonds have higher yields than government bonds. Higher yields are bad. Why is that? The rule of thumb is this. So if the discount rate or the corporate bond rates, the single equivalent rate, for example, and that's another term which I'll get into more definition in a bit. If that increases 1%, then the value of your pension goes down by approximately 10%. So, but if the corporate bond rates decreased by 1%, it's an inverse relationship. So if the corporate bond rates decreased by 1%, then the value of your pension lump sum goes up 10%. So very important. We track this meticulously, and I'll get into some of the data on how we do that. Also, the mortality table that the IRS utilizes, it's released by the IRS annually. And this basically first affected pension plan participants in 2013. So born after 1957 or hired after 1997. So now we'll go into some of the data. So this is what segment rates have looked like since they've been published. So this is a good 30,000-foot view of what's been going on. If you see the green line at the bottom, segment rate, basically segment 1. Segment 1 is your shorter term rates, which are 6 months to 5 years. If you notice, there's a lot more volatility on the green line, which is segment 1, which is covering basically 6 months to 5 years. And then segment 2 rates are the blue lines. That's covering years 5.5 to 20 years. And then segment 3, which is the orange line, that's covering rates much longer term. So rates from 20.5 years to 60 years. So shorter term rates can be more volatile, but each of those segment rates uniquely affects your pension calculation. So, recently segment rates have come off their historic low, and we'll talk more about that in the next few slides. So let's go ahead and drill down on the items that I discussed on the last slide. So a lot of good data here, a lot of numbers, and we'll just walk you through it. One of the biggest things to know is that only the last 2 months in the quarter are used in the calculation for interest rates. So Bogart Wealth tracks the daily rates for each segment and compares that published data to our projections. So just keep in mind that the rates in the first month of the quarter. So for example, if, on your screen, if we look at segmented rates for second quarter 2026, those rates, if we look at segment for October, November, and December, the ones that count are November and December of 2025. Those determine what the rate will be for Q2. So October is there, but you can see it's in gray. The ones that count, that make up what the actual rate would be, are just those last 2 months of the quarter, November 25 and December 25. And that would be applied to the second quarter of 2026. So just a couple of other notes. On the left-hand side, if it says actual, So these numbers have been published by the IRS. If it says projected, then it's a Bogart, basically a value from Bogart Wealth's model. Now, the right-hand side illustrates, how we make a projection as a month is in progress. Namely, we start with the last known month. In this case, in this example here, November. So for November, we have what the IRS published as segmented rates and what the Federal Reserve Economic Database, the acronym is FRED, what they publish for corporate bonds of various maturities. In a nutshell, we're tracking how corporate bonds change during the month. We also track how Treasury bonds change during the month, but we're not showing that data here on this presentation. To sum it up, we're looking at how the average has changed from the last known month to the current month. From that, we make 3 different projections and then average the 3 to get our projection. So that's a little bit of how we get the numbers and make our projections. So you have those 3 segmented rates. If you look at the segmented rate history on your screen, we have data going in this presentation from 2021 to 2025. You see segment 1, 2, and 3, and you can see data from a specific quarter applies to the quarter corresponding. So for example, in the last example I utilized, data from 4Q 2025 applies to second quarter 2026. So if your benefit commencement date is in the second quarter of 2026, then you'd be utilizing the rates from 4Q 2025. And you see here the segmented rate history, 1, 2, and 3. You see what the rates are, segment 1 at 4.03 as an example. So one thing to keep in mind is that it's important to note that the annuity option, right? You have your lump sum, you have your annuity option. Another thing to take away, another big takeaway, annuity option is not affected by the changes in rates we are discussing right here. So for the non-grandfathered folks in the room, you know that there are 3 different groups of interest rates that apply to you. But, it may be hard to look at 3 different rates. It's a lot of data, potentially moving in different directions, and developing an understanding of exactly how much these rates have changed the bottom line. Because when it comes down to it is how much does it affect your lump sum when it all comes down to it after we do all the math. So one way to kind of help simplify the process is Bogart Wealth helps you calculate what would be a single rate equivalent so that you can more easily measure quarter-to-quarter changes in rates. And by the way, we do send out a periodic, I believe it's monthly, email on updates on our projections and data for these rates. If you'd like to sign up for that email, please click on that QR code. It'll take you to our contact page. Lots of great data. And again, we send it out periodically on a regular basis. And that way you can track it in real time as we go throughout the year. So just a quick note, housekeeping note on that. So for example, if you're comparing Q1 2025 rates to our Q2 2025 rates, just by looking at the 3 segments quarter over quarter, it is hard to see what the projected difference is. But look at the retire at age 55. So on the right-hand side of the screen, if you look at retire at age 55, you look at the single rate equivalent, you can see clearly the actual Q1 rate is about 4.98%, and the Q2 rate is a bit higher at 5.34%. So that makes the data a bit easier to digest as we go through the numbers and as you're going through the numbers as well. So monthly and quarterly rates since 1984, if we step back and look at average corporate bond yields, or the single equivalent rate is what we're looking at. We're going to look at the monthly actual data and then the quarterly discount factor. But to recap, in the last few slides, the charts detailed short-term moves in the single rate equivalents for the non-grandfathered folks. Well, we wanted to take, again, a step back, look at the historical viewpoint and point out that corporate rates similar to the 30-year Treasury rates on an earlier slide, have moved well below the highs that we saw in the 80s and 90s. Of course, as a lot of you remember, during the pandemic, rates dropped to the lowest level in decades. And since then, we have seen these rates move higher, but well below the highs from a few decades ago. So if there are any questions on rate projections, please contact a Bogart advisor. We're always happy to discuss the potential impact on your financial plan. Okay, so another great slide. So now we get into some of the calculations. So now what we're looking at is, the example of taking a lump sum at age 60, and we're basically calculating the present value of an annuity. So we've discussed the interest rates and what interest rates are used for the ExxonMobil pension. This slide gives you a great data points on how does this impact my lump sum. So one of the things to think about is that when you retire, you don't have to elect the pension. You can retire, and there's nothing that says you have to elect the pension option once you retire. You can retire and then elect the pension option later. This is something that you would need to work with your Bogart advisor on. There's a lot of moving parts to that. Again, at Bogart Wealth, it's comprehensive financial planning for corporate professionals and executives. We work with a lot of folks from ExxonMobil, so we know all the ins and outs. And really, this is one piece in the bigger part of your overall financial plan, your assets, your goals, expenses, etc. But that's why it's definitely helpful, and a lot of folks have found it helpful to do that free consultation just to get the data points for your specific situation. And then once you meet with that Bogart advisor, talk about whether or not this makes sense for your specific situation and for your family. It's a huge decision and definitely something to talk in depth with an advisor about. So in the next couple of slides, we're going to do a deep dive into the lump sum calculations. Again, interest rates do not impact the annuity values. So in this example, we want to discuss the impact of age, life expectancy, and interest rates on your pension. So for this example, we're assuming, okay, a 60-year-old retiree with an annuity value of $74,247. So that equates approximately to a $1 million lump sum. Now, what are the factors that affects this? Well, let's first talk about life expectancy. In this example, their life expectancy is 84. So you can see we model out payments through age 83. During this time, the annuity payments remains the same, $74,247, but the segment rates change. Remember, it's very important. There are 3 segment rates. And so segment 1 for the first 5 years, segment 2 covers years 6 through 20, and segment 3 covers years 20 and after. So for this example, we're assuming segment 1 rates are at 4.13%. So that takes our example here of our potential retiree at age 60 through age 64, and that's when those 4.13% interest rates would be applied. Segment 2 is at 5.2%, and segment 3, when you look farther down on the chart, at 5.98%. So all of these factors combined, life expectancy, annuity estimate, and the segment rates would project this retiree's lump sum to be approximately $1 million. And let me get to the next slide. Give me one moment. Okay, perfect. Now we're going to take a look at a younger retiree. So this example, let's say retire younger at age 55. And we're going to look at how the factors affect their lump sum value. So you can see that the segment rates stay the same. Just one more time, again, just for reiteration, segment 1 is for the first 5 years, segment 2 years 6 through 20, and segment 3 for the remaining years. So for this example, again, same segment rates. Segment 1 is at 4.3, segment 2 at 5.20, and segment 3 at 5.98. But let's look at this. What changed is the annuity is less. So now we're looking at the annuity value of about $55,685. Why is this less? Because there is a reduction in the annuity payout if the benefit is taken early. So basically, since this particular person, if they chose age 55, what they're doing is they're assuming the annuity is now 75% of what it was in the prior example. So basically a 5% haircut every year if you go back from age 60 to age 55. And so now the value of the annuity is 75% of what it was in the prior example. Now, life expectancy here is 1 year shorter, but there are more annuity payments that need to be factored in because the benefit is happening earlier. So while I said the segment rates are unchanged, the years in which they are being applied to has now changed. So you can see that from age 55 to 59, you are applying to segment 1. So now a person at age 55 will have more years in segment 3. So now the lump sum for this retiree will be more sensitive to changes in the segment 3 rate, that longer term rate, the 20-year plus rate. So that's just one thing to keep in mind in terms of the age factor in terms of calculating the lump sum. So here a little bit more on the math background. The calculation of the single equivalent rate, it's basically the internal rate of return that is needed to get to the same lump sum value using the 3 segment rates. Now, this is a little bit in the weeds, you could say. So if there are questions about the exact calculation, please reach out to a Bogart advisor, and we'd be glad to walk you through it. Okay, impact of interest rate changes on lump sum. So one of the things, and I'm just make sure how we're doing on time. I want to make sure we get through the presentation. So a question that we help a lot of clients and prospects with is, how do changes in interest rates affect their specific lump sum? So let's continue with the previous example. So that example, the lump sum for a 60-year-old retiree was approximately $1 million, and the single rate equivalent was approximately 5.27%. As we think about what changes in rates would do in this example, let's consider a few rules of thumb. And remember, earlier in the presentation, huge takeaway, a 1% change in the interest rate affects your lump sum by 10%. So again, if there is a decrease of 1% in interest rates, the change in your lump sum will increase by 10%. If interest rates increase it's an inverse relationship. If interest rates increase by 1%, then the change in your lump sum decreases by 10%. So very substantial. And we can assume, for less than 1% is linear in terms of the calculation. And if you look at this scenario, for example, October 2025 versus September 2025, discount rate increases by 0.10%. That's the single equivalent. The lump sum estimated increases by 1%. Or you could look at that as $10,000 for each $1 million of lump sum is another way to look at it as well. So going back to some more data. So this slide is designed to build on the 60-year-old retiree example. So you may be wondering, why is this top bullet, why is this crossed out? So in the earlier example, we first showed a simplified example of how one might go about calculating the lump sum from the annuity. And I'm going to take a quick sip of water. Excuse me, just got a little thirsty. Um, so again, just to recap, um, we first showed a simplified example of how one might go about calculating the lump sum from the annuity. So you can see that the shift higher in assumed discount rates made the lump sum value lower. But remember, it does not change the annuity payment. In each example, that annuity payment is $74,247. Okay, now this is a question that we discuss a lot with folks from ExxonMobil and other companies as well. Should I retire now and delay the lump sum? So this is a question we often discuss, when to consider delaying the pension. So a quick note, remember delaying is only for the qualified portion. So if you are going to be receiving the APP and the SPP, those are going to have automatic payouts. They pay out about a month after the retirement. So about a month after you retire, you're going to get that payment. Those are automatic. So again, that's the non-qualified portion, the APP and SPP, for example. So delaying is only for the qualified portion. So everyone's situation is different. Just definitely talk to your advisor about that. So the things to keep in mind when you're talking with your advisor on this question, there's several things that go into play. So one is, when you may need the money. Two, if you're retiring prior to age 60, that's a factor. And then the potential for interest rate changes in the future and how that may affect your financial plan. So we're really looking at several factors in going through this question. So now, just like to take a step back. This is our retirement roadmap for an example of someone that has a March 1st, 2026 benefit commencement date in this example. So when we're thinking about the decisions that need to be made for retirement, we've created a list of key events to be mindful of what's coming up and how to stay on track. So here is another format of this presentation, of the slide before. Attached, again, the example of someone with a benefit commencement date of March 1st, 2026. So typically, you want to inform your supervisor approximately 90 to 120 days out. So that's going to include things like the last day on payroll, the first day of retirement, and the benefit commencement date. In addition, you'll want to request your ITR. That's the acronym for you want to request your intent to retire package. So after you receive your intent to retire package, you'll need to review and complete it with notarization. At this point, you'll review the lump sum annuity election form, the qualified rollover form, a couple of other forms as well, address verification form, and then the non-qualified pension election form. So you must return this at least 35 days prior to your benefit commencement date. And also, don't forget, it's important to change the medical plan payment method on the ExxonMobil benefits website. So that's another kind of housekeeping item, but very important to remember when you're going through the process. So fast forward to within 1 or 2 days of the benefit commencement date. You've worked hard to get to this point. Now it's coming to fruition. The lump sum rollover check delivered to you by mail. So this is within this time frame of within 1 or 2 days of the BCD date. The supplemental pension, if applicable, is paid via payroll. Next, you'll hand deliver or send via prepaid UPS to Bogart Wealth for the check, for the lump sum rollover check. And you'll want to really all these different factors. There's a lot of different moving parts, a lot of different forms. One thing to keep in mind is it's so important that you meet with your advisor, your Bogart advisor, to go through these items, make sure everything's done in its proper form and place. And finalizing, of course, the planning, the big picture, because everything that we're going over in this webinar today is just one piece of huge, major, life event. But it's also a part of your overall bigger financial plan. So that's one of the things that we bring as advisors is, we're going to help walk through finalizing cash flow, looking at your investments, looking at tax planning, looking at net unrealized appreciation planning opportunities, Roth conversions, etc. Everyone's situation is different. But again, how do we maximize tax efficiency? How do we make sure that we are maximizing the opportunity in terms of what's going on with discount rates, etc.? So just to take a step back, as we, 5 to 10 days after retirement, we will meet to complete the savings plan rollover call. And then 10 to 15 days after the rollover, a savings plan check is received at Bogart Wealth. The savings plan IRA Exxon shares are received at Bogart Wealth, and a couple of other items as well. If we did the net unrealized appreciation strategy, we receive that statement, which is emailed to us as well. So this is a lot to process, but we are happy to help with any questions or items that you'd like to discuss along the way. And we do have this available for folks. So a lot of good data here as a good template for things to expect and what to think about as you get closer to, possibly retiring. So now I'd like to just switch gears for a bit. And, we went over discount rates, how they're calculated, changes from the Pension Protection Act, going through the math of that so you can kind of see behind the scenes on how we advise folks on retiring from ExxonMobil in terms of the lump sum versus annuity, but specifically on that lump sum payment and how interest rates affect that, and the calculations behind that. Now I'd like to talk about covered call strategies. So this is one of the things that we do at Bogart Wealth for our clients. And just if you see the slide that's pulled up, basically, again, an intuitive definition of selling covered calls is this, and I'll just go ahead and read it. When a stock investor sells a call option against their shares, so for example, you have 2,000 shares of ExxonMobil sitting in a brokerage account. You utilize a net unrealized appreciation strategy. Those shares were moved from your 401k. We utilized NUA during the rollover. Those are now sitting in a taxable brokerage account, or you could have NUA shares, so your Exxon IRA shares, and those are sitting in an IRA account. Either way, you can basically sell a call option against a portion of those shares. When you do that, you're going to accept a premium for the option premium as a payment for giving up. So what are you doing? So someone's going to pay you, and what they're paying you for is that you, by receiving that premium, you're giving up all the upside potential in the shares above the strike price. And I'll go through the definition of what all this means and break it down and go through an example with everybody on the call today. So, in other words, by selling a call option against 100 shares of stock, for example, you're selling the profit potential on the shares above the strike price of the call that you sell. And again, of course, with this year and volatility, and of course, with the ExxonMobil stock price and the changes and increases and all the changes that have happened this year, and even outside of this type of volatility, covered call strategy is something that may be applicable to your situation. And again, talking to your advisor and working through and seeing what that would look like for you guys, for your specific situation. So the covered call terminology, I said a little bit of this in the previous slide. 4 things to keep in mind. The strike price. What is the strike price? All that means is if I'm going to write a covered call, let's say that I have those 2,000 shares of Exxon non-NUA or Exxon IRA shares and it's been rolled over to an IRA. It's sitting in there, and we want to write covered calls on a portion of that Exxon, of those 2,000 shares of Exxon stock. And let's say that, Exxon right now, it's a 148, 150, and we want to set a strike price. And there's a lot of factors that go into that. And working with your advisor will determine what options for strike prices could be. But it's basically saying at this price, so let's say price of Exxon right now is 150. We set a strike price of $160. So if the stock price of Exxon goes back up to $170 at some point in the future, because you've sold this option on, let's just say 100 shares out of those 2,000 shares of Exxon stock, those 100 shares, you've got a premium per share. So you've received that when you sold that option, this covered call option. What happens next is, well, the person that you sold that option to, they're like, well, hey, the price is at 170. I'm going to exercise this. I paid for this. So now what they're going to do is, the strike price is at $160. So they're going to be able to buy the ExxonMobil stock at $160. And so what you're losing out on is that $10 of appreciation per share, because now it's now at 170. So that's just a brief example. We're also going to look at time frame, the premium, which I talked about briefly, and then the underlying stock. Charts always help me, and hopefully this will be helpful in understanding the concept. So the covered call strategy illustration. So in this scenario, what we're looking at is, okay, let's say that the stock price is at $100. So if we go through the definitions, so the premium is the dollars that you receive for selling the option. The other thing to keep in mind is that when you're selling options, one covered call, they're also called contracts, right? An option contract. So option contract, one covered call, that equals 100 shares. If you did 10 calls or 10 contracts, then that's 1,000 shares. So the strike price, that's the agreed possible sell price. And that's at, in this example, $120. In that prior example I just stated, even though the person that you sold this covered call option to, let's say that the strike price was 160, Exxon's now at 170, that individual who owns the option, you would think that they may exercise their option rights to buy it at 160. However, they may not do that. They don't have to. So that's just a quick note about this as well. They're not obligated to do it, but they have the right to do it if they want. So going back to this page, what we're looking at, if we look at 1,000 shares times 3, that's $3,000 call premium. Okay. Thank you, Ronaldo, for the question. Remind us what the APP and SPP is. So great question. Those are the non-qualified portions of your pension from ExxonMobil. And so I'll go through the SPP first. So that's your supplemental pension plan. So that is the non-qualified portion of your pension. There's also the APP, which is additional payments plan. So if you are able to get that as part of your package from ExxonMobil, what that means is this: you're going to get, so whatever that amount is projected at, that is going to be paid out, and there's no way to delay it. It's just automatic, basically. So I'll go through an example. Let's say that you retire at some point this year. You have your benefit commencement date. I'll just make up something, November 1st. About a month after you retire, after your benefit commencement date, you will get your supplemental pension plan payment and also your additional payments plan payment Those, by the way, are taxable as ordinary income, and ExxonMobil will withhold a certain percentage of taxes on those amounts. The withholding is usually 22% from those payments. So you have the gross amount. ExxonMobil will automatically withhold 22% for federal tax withholding, and then you get the net received paid to you. So those automatically go out. So that's one thing to keep in mind too, and that's meeting with your Bogart wealth advisor. What's the tax impact of all this? What's the overall, what are the other things going on? Am I receiving restricted stock units? Did I do net annualized appreciation? What's my overall projected income for the year? These are all things that we go in depth in terms of our, for example, one of the things that we do is tax planning. But in big picture, they're the non-qualified portion of the pension, and they're paid automatically a month after your benefit commencement date. But great question. Thank you for the question. So on the covered call scenario, I'll just finish walking through it with you guys. So the outcomes are this. If the stock price was at 100, we did the strike price. We wrote the covered call. We put the strike price at 120. The premium was $3 a share. Let's say we did 1,000. We wrote covered calls on 1,000 shares. So now we just received $3,000 for selling this covered call option. And the outcomes could be this: the stock stays under the $120 through the expiration date. And that's the other main thing to keep in mind is so that time frame. When you write a covered call, you're going to list the stock. So ExxonMobil, for example, the strike price in this situation, it's 120, and the expiration date, which means how long is this option contract lasting? So you pick an expiration date. It could be 3 months out, 6 months out, a year out. Lots of different variations on that. A lot of different things to consider, but your Bogart Wealth Advisor will walk you through that. And then the other outcome, stock goes over 120 before or through the expiration date. Okay, great questions. So Thomas, thank you for the question. Do you use the covered call strategy only in qualified account for tax strategy, or can you use it in non-qualified accounts? Great question. You can use the covered call strategy in either a qualified account or a non-qualified account. And depending on your overall situation and financial plan, and your overall asset allocation in your portfolio, we'll take all that into account in determining which account we would utilize, but you can use either one. One thing to keep in mind too is, what were the number of shares that were in a non-qualified account from the NUA shares that moved over to the non-qualified or the taxable brokerage account, and then how many shares moved over to the Exxon IRA shares to the if we rolled it over to an IRA, now they're sitting in an IRA. But we'll look at all that data to determine specifically which account to use, and then the number of shares and all the other items here. So thank you so much for that question, Thomas. And then how did we get $3? Great question. So anytime that when we place covered calls for clients, one of the things that we do as your advisor is, the covered call, it's basic options. There's markets for options and supply and demand. And also, we look at the details in we have a great portfolio management team, trading team that will really dig into the weeds for us and for you. We work as a team together on, there's a bid price and an ask price for various calls on various strike prices and on various expiration dates. So A lot of that data can be found online. Our trading team looks at the data, and we determine between the bid and the ask price. We get into the weeds of like, what's the most premium that's we could utilize for this particular potential covered call. So is the $3 related to the strike price? So yes, there is a relationship to the strike price. And so depending on the strike price, whether let's say it's in this example, the strike price is $120 versus the strike price being $150, yes, that directly affects the premium as well. And also the time frame to expiration also affects the premium as well. And the next chart I'll show you guys, kind of if we look at this covered call strategy illustration. So the initial $100 stock price received a premium on the covered call for $3. The stock goes up in this case to $125. So what happens is the strike price was at $120. So now the person who held the option that you sold the option to, they'll be able to buy the Exxon stock at $120. That's the benefit that they get because it's now trading at $125. The premium, whatever happens, you always collect your premium and keep it. The opportunity cost, and this is part of, when you do the option, is that the price increases past the strike price. And so the opportunity cost is $2 in this particular situation for covered calls. It can be a great component of your overall strategy for your financial plan, depending on a lot of different factors. But we definitely believe it's important for folks to know this is something that can be utilized in terms of, and let's look at the big picture. If we step back, what are the pros and cons of covered calls? So advantages: one, you're going to earn additional income while retaining the stock. A lot of times, our clients have substantial amount of ExxonMobil stock. And so how can we generate additional income while retaining that stock? Covered calls are a possible strategy to do that. Does offer some downside protection. And it's also a great strategy to divest shares. What are the disadvantages? What are the cons? There's always pros and cons to a situation or any strategy. What are the disadvantages? Well, as we just saw on that past slide, you're going to cap the upside profit. Also, you may be required to sell the stock if that person exercises their right on the option that they bought from you. And then also another disadvantage is downside protection is limited to the premium that you received on that covered call. So just to make sure that I get through the rest of the presentation, we've gone through discount rates, how they affect your lump sum. We've gone through the calculations. We've gone through some scenarios for covered call strategies, the pros and cons of those, and how they can fit into your overall financial plan. Again, meeting with the Bogart advisor to see how that would work for your specific situation. But just a couple of items that are important to note in terms of financial planning for this year and going forward. So we do have catch-up changes that are occurring. So I'll just walk through this with y'all. So starting in 2026, new retirement plan rules will change how catch-up contributions will work for higher earners over age 50. So if you're still working, here's what you need to know to take advantage of the opportunity for catch-up contributions. So age 50 catch-ups must be Roth. So that went into effect this year. So if your FICA wages, which is, if you look at box 3 on your W-2, if those FICA wages were over $150,000 in 2025, and you're age 50 or older, any catch-up contributions to your 401k will need to be made as a Roth or after-tax contribution. So it depends on your retirement plan. So this rule only applies if your employer's plan actually offers Roth contributions. If it doesn't, high earners won't be able to make catch-up contributions to the plan at all. In that case, a Roth IRA may be a valuable option to consider. So turning 50 this year counts. That's another thing to keep in mind with some of these changes this year. So you don't need to be 50 at the start of the year. So if you turn 50 at any point during the year, you're eligible for the catch-up contribution. So that's a great housekeeping note to keep in mind as well. And then also too, just with some of these changes, there's even more flexibility for ages, if you're age 60 through age 63. So if you're between those ages, 60 and 63, you'll be able to make an even larger catch-up contribution. So I'll just walk through it with you. So you'll be able to make up to $11,250. That's up from $8,000. This higher limit applies to both Roth and traditional contributions. Now, these changes could have a meaningful impact on your tax strategy and long-term retirement plan. Again, talking with your advisor to see how it affects your overall plan and how to implement, going forward as you're talking with your advisor. Here, just a quick 30,000-foot view of the One Big Beautiful Bill Act. Some things to keep in mind as we go through this year in terms of financial planning and how these have affected, different areas for your financial plan. One, tax rates. So the tax in 2017, Tax Cuts and Jobs Act lowered tax brackets and increased standard deductions. So now with the One Big Beautiful Bill Act, the lower tax brackets and increased standard deductions are made permanent, which is great in terms from a planning perspective because now we know, okay, hey, these are permanent at this point in time. Seniors gain an additional $6,000 deduction per person if they're age 65 and over, subject to certain income level restrictions. You also get there's a child tax credit that increases to $2,200 as well. Another key planning item as you're going through your year of planning and meeting with your advisor, that state and local tax deduction, or SALT, the acronym is normally referred to. So the SALT deduction in 2017, it was limited to $10,000. The laws changed with the One Big Beautiful Bill Act. So the SALT deduction has been raised to $40,000, subject to phase out for high income taxpayers. Part of what we do at Bogart Wealth, of course, in addition to investment management, is we look at tax projections throughout the year. We look at tax planning and looking at, okay, in your overall situation with capital income, dividends, et cetera, perhaps you get the SPP and the APP, non-qualified portion from your pension plan, all areas of income. And then we look at your various deductions. What amount would you actually qualify for depending on the income level that you're at, that you can qualify for that deduction. And gift and estate tax lifetime exclusion. So in 2017, it was at just $13.9 million gift and estate tax lifetime exclusion per person. So now with the One Big Beautiful Bill Act, it's increased to $15 million per person. So for joint filers, that's $30 million worth of gift and estate tax exclusion, over their lifetime. So that goes into effect this year for the gift and estate tax lifetime exclusion change. And then charitable giving, this is very important to note as well. There's a little bit of nuance, but definitely something worth noting, and bring it up with your advisor on the specifics for your situation. So in 2017, charitable giving donations deductible up to the limits without requiring contributions to exceed a minimum threshold. Well, it's changed now. So now you get a permanent above the line $1,000 deduction for charitable distributions, $2,000 for joint filers, subject to a 0.5% adjusted gross income AGI floor on all itemized donations. So to help put that in English, so let's say that you have a certain amount of income for the year, and let's say that we set up a donor advised fund for you, and that we're going to donate a highly appreciated stock from your, one of your brokerage accounts to the donor advised fund. What the thing to keep in mind is with this law change now, the amount that can be listed as a charitable deduction on your tax return, on your tax planning, is you cannot include these basically 0.5% of your AGI. So as we go through these tax projections throughout the year, we'll estimate, okay, hey, you're looking at this particular amount of AGI for the year. If we decided to we'll run through scenarios with you. If you made a donation of charitable appreciated stock to donor advised fund, this amount after that 0.5% floor will tell you the specific amount that would actually be considered a charitable deduction. So a little bit of nuance, but definitely important to remember. All these pieces come together for your specific financial plan. So wanted to touch base on that as well. And just to wrap up, again, appreciate everyone joining today. Strategies to consider now. So if we look at it, if you don't have a plan, make sure you get one. It can be very helpful to develop a plan to alleviate any uncertainty as you transition to retirement. It's a very big life-changing process, and so it's normal to have that uncertainty. And so definitely meeting with an advisor, and we'd love to help you here at Bogart Wealth create a plan. And one of the most underrated planning items for retirement is having a budget. So it may not be the most fun exercise, but it's very, very important that you have a budget to monitor spending throughout retirement. The budget helps you determine your financial planning needs. So that's, again, it can be underrated planning items, but definitely crucial to have a budget to monitor spending. And also, it's important to understand your long-term risk profile. And that will help you understand which pension option is best for you. So all these factors going together. So it looks like we're just over time. I do see one question. Let me see if we can get to that. Thank you, Thomas. So in this pension example, life expectancy is 84. Is the annuity contract expire on the life expectancy table or actual life? For example, the lump sum at 60, will you continue receiving $74,247 until age 84? Will this payout continue if you live until 100? That is an excellent question. Thank you for asking that. So as long as you are living, the annuity will pay out. So it pays out that amount for the rest of your life. So let's say that 60-year-old, they live to age 95, that annuity is going to be paying out every year that individual is alive. So it does not stop at the life expectancy. This was more for like that example of this person actually, passed away at this certain time. This is what that would look like. But great question. As long that person is alive who's receiving the annuity, that will continue for that person's lifetime. And then the other thing too that you'll talk through with an advisor is, there's various annuity options. There's a survivorship annuity, et cetera, a joint annuity, a lot of different options, but we'll walk through that with you. But big picture, as long as you're alive, the annuity keeps paying. So thank you, Thomas, for the question. That's a great question. So again, we're here to help you, qualified and experienced. I'm a certified financial planner, financial advisor. We have a great team here of other certified financial planners. You want to talk to someone who's a certified financial planner, knows your retirement plan, knows the IRS retirement rules, has navigated multiple business cycles, and manages portfolios. Again, discussing various strategies one of the things that I guess conclude is that if you don't have a financial plan, there's never a bad time to take the steps to get one. So at Bogart Wealth, we are very happy to meet with you, learn about your situation, learn about what's going on in your life, learn about your goals, and determine how we might be able to help. Again, free consultation, no obligation. That's part of a way of building relationships with folks. So again, these are just some of the things that when you're looking for a financial advisor that you want to know, and you want an advisor who can speak in a way that you can understand. Because a lot of this can be nuanced at technicalities, but really it's we firmly believe in education, so that the more our clients know, the better. So again, if you'd like to meet with myself or any of us here on the Bogart Wealth team, please go ahead and scan this QR code. You'll pop up on our website to enter your contact information and email. Our team will reach out and we'll set up an introductory conversation with you. And that is our presentation for today. Thank you so much, everyone, for joining us. Thank you again, everyone, for your questions. Excellent questions. And please attend our upcoming webinars and podcasts. Got a lot of great stuff coming up. I hope you have a great rest of the day. Thank you so much.